Identifying the market's direction and its reversal levels can often be confusing because the market sometimes tends to make false signals before an actual trend reversal happening on a certain market. So the question is, how can we identify the real reversal levels using price action and smart money concepts? In today's video, we will show you can we notice potential reversals using smart money strategies combined with the RSI indicator. Without further ado, let's begin. What is the RSI indicator? The RSI stands for the Relative Strength Index, and it's a momentum oscillator that measures the speed and change of price movements. The RSI can help traders recognize potential trend reversals and show a no-MIMAL estimation of the price, such as a market being oversold or overbought. To add the RSI indicator to your chart, you need TradingView, and go to the Indicators tab and type RSI and click on the Relative Strength Index. We can also do some modifications. We click on the settings of the indicator, click on the Style tab, and disable the RSI-based MA. You can also change the color right here, or make the lines thicker. I will make some points thicker so it becomes easier to see. When the RSI rises above the 70 line, it indicates that this market is temporarily overbought, meaning price has followed an uptrend increasing by a lot in a short time period, and there is a probability that this market will soon have a correction or a trend reversal. When the RSI falls below the 30 level, it indicates this market is now oversold, meaning that the price has decreased significantly in a short time period, and there is an upcoming probability that this market will soon bounce back to the upside or reverse a trend. This is how retail traders usually use this powerful indicator. The problem in this situation is that the market can stay overbought or oversold for longer than most traders believe, so if you trade solely using the overbought and oversold concept, you will likely lose many trades. But there is a way of using the RSI not many people know about. It is done by identifying divergences that could potentially indicate a higher probability trend reversal on a certain market. First, we need to know what is a divergence. The divergence is an event of price moving in the opposite way of an oscillator, in our case, the oscillator being the RSI. Let's take a look at how the divergence can help us look at the chart in a better and different way. On this chart, we can notice how prices managed to create a higher high, but taking a look at the indicator, it did not mirror the price itself, and instead it created a lower high. This is called a bearish divergence. This indicates a loss of buying strength, and we can see afterwards how this market crashed shortly after. Now the other way around, price is creating lower lows right here, but the indicator prints a higher high for the same period. This is called a bullish divergence, indicating that price could soon to reverse to the upside right, as we can see it did. There are some tips and tricks that, if applied correctly, it can improve the quality of the signals given, such as the first one. Use the divergence mostly when the RSI is at the two extreme levels, meaning above 70 is overbought and below 30 is oversold. You can also use the middle of the range, but it will print many more false signals. The second rule is using the divergence during trending markets for a more clear direction of the price. If price is in a consolidation, it becomes much harder to recognize a trading opportunity, and false signals are more often met. The third rule or trick is to use the divergence after a macro trend. The longer the trend, the easier it is to notice when the divergence will happen, giving more chances to observe a trend reversal that traders can join and potentially profit from. While the RSI divergence is a great tool that indicates the strength and direction of a market, the common problem is it can't be used alone in an efficient way as an entry strategy, because as we saw, price can move in the same trend for much longer, even if the RSI is very oversold or very overbought. To fix this problem, we can use smart money concepts, entry strategies in combination with the divergence. One smart money concept we can use is the change of character. On a bullish market with continuous breaks of structure, once the price is broken and closed below the last lower low, we call it a change of character, indicating a very strong potential reversal. The change of character happens because buyers are losing strength and the control goes to the seller. Here we use the RSI divergence that we have learned in the first part of the video as confirmation of a reversal. On this specific illustration, a seller's market is characterized by a bearish divergence. On the bearish scenario with continuous breaks of structure, once the price manages to break and close above the last lower high, This is called a bullish change of character, as an indication of a very strong reversal point to the upside. This setup is a high-quality one. If we observe a bullish divergence formed before the change of character, meaning the price formed a lower low, but the RSI has formed a higher high. Let's put it all together on a live trade. This market has been going up. Here we observe that the candles have formed a higher high while the RSI has created a lower low. This is a bearish divergence, and we expect price to go down either to take liquidity, to drive it higher afterwards. Either this is a trend reversal. The crash comes with an instant push to the upside. This usually indicates the downtrend was a liquidity sweep. This market has changed character, giving us a confirmation that we have entered an uptrend. What we don't want to do is predicting the reversal right away. This is the cause of many stop losses being hit. Now knowing we are in an uptrend, we move into a lower time frame for the entry execution. The following candles have printed an imbalance, giving us the chance to buy. Placing the stop loss below the imbalance zone, and knowing that we are right at the change of character area, and this market is likely to go even higher. I will take profit at a higher risk to reward ratio. Another way is done by using premium and discount concepts. This is done with the help of Fibonacci retracement tool that we can find on the left side bar in TradingView. In a bullish market, we take the Fibonacci from the low to the top of the impulsive move. We want to disable all levels beside 1, 0.5, and 0. These are all the levels we need. Between the range of 0.5 and 1, it is called a discount zone, where price usually reverses to the upside after the retracement has finished. This is a very easy strategy, and the RSI being down also helps us. And even if I buy right at the close of the candle that breaks right into the zone, this is win trade. But of course, the easier it is, the hardest it is to make a decent to high risk, to reward ratio noticeable here, that we can't look for more better opportunities. By the way, this can be applied to more trades after this one, but the RSI going higher increases the risk of the trade going into a loss. In the bearish scenario, it is the opposite. We take the Fibonacci from the high to the low on an impulsive bearish move, and the zone between 0.5 and 0 is the premium zone where price usually reverses to the downside after the retracement has been done. For a more clear execution, we can enter a lower time frame. This is the 1-minute time frame. Make use of the many smart money strategies learned because they combine and can potentially increase setup quality. Here, for example, the price has failed to break the last important high-showing buyer's weakness. This comes in confluence with the following bearish order block. At the same time, we have the RSI being high up enough, indicating the micro trend, which is an uptrend, could soon reverse into a downtrend moving in the same direction of the macro trend. The change of character can also be implemented into the premium and discount strategy for a better quality entry price. On an uptrend example, when price falls into the discount zone, the micro trend being bearish, we look for a change of character that reverses the micro trend and continues the larger bullish trend. This is all for today. Thank you for watching.